What is happening, best ever listeners? This is Matt Faircloth, and welcome to the best ever CRE show. This is your buddy Matt Faircloth coming at you, your host every week on Fridays. Make sure you mark your calendar for Fridays so you can listen to my segment called Next Level CRE. And if you got time, listen to all the other hosts too, because they are amazing as well. But make sure you come see me on Fridays too. Guys, we're going to be talking about an interesting topic today. And I've got a very special offering for you guys. Because this is not just a podcast. You guys can also go and join a webinar. Best Ever, this is like part of the Best Ever toolbox. Best Ever has a phenomenal webinar series that a lot of people go and attend. Hundreds of people attend these webinars every month. So you guys can go and join the webinar. If you like the topic we're going to be bringing to you guys today to discuss, I want you guys to go to bestevercre.com/hotels. bestevercre.com/hotels and register for the free webinar where you can hear more about this phenomenal conversation we're going to have today. So, and I'll introduce this conversation myself personally. I grew up playing Monopoly, okay? As y'all probably did too. And you get a little greenhouse and that kind of tea, it's like landlording 101, right? But when you get enough little greenhouses, you know what you get? You get a big red, it's not an apartment building. That's not an apartment building. It's not a big red apartment building. That's a big red hotel. Okay. And today's conversation is about the asset class that I think is hiding in plain sight. A lot of people don't talk about hotels as an asset class, and we're going to unpack it and talk about why hotels are an amazing asset class. And if you guys like I said, if you guys like this conversation, register for the webinar. Again, bestevercre.com/hotels. To talk to me about hotels is my fellow DeRosa team member, the Hait Patel. Hey, welcome for joining. Thank you for joining me on the show today on Best Ever CRE.
Thank you for having me, Matt. I look forward to our conversation here.
Yeah, I'm looking forward to it as well, because you've really taught me a lot about hotels as an operator and about why hotels are something that people should be even thinking about, because it's one of those things where it's like, I didn't even know you could buy up until a couple of years ago when I first met you. I didn't know hotels were a thing that people bought. I thought that Hilton and Marriott and those guys own those hotels, right? So we're going to unpack all that. Give us a bit of your backstory and how you even got into the hotel space and a bit of the Hait Patel origin story, if you don't mind.
Yeah, so similar story to many of the second generation Patels. I mean, I'm a first generation. Me and my parents, we came here back in 2006. And my parents worked in hotels that were owned by their friend's family. And then, in 2008, they bought their first property. And that was a small property, 29 rooms in South Dakota. So it was quite drastic change, coming from India and then moving to South Dakota after all the winter. The winter were a bit brutal.
Did it have like snow and cold in India where you were from? Or
no, most of the Patels are from a state called Gujarat, and it does not have. It's very hot climate in Gujarat.
And you go, why South Dakota?
Well, that's where the opportunity was.
That's where the deal.
It was a small motel, actually, 29 rooms, independent, and it was interior corridor. They looked at a lot of other businesses, family help like gas stations and convenience stores and all that kind of sorts, but they were fixed on doing a motel. I guess that's what a couple of other family members were also in the motel industry, and a couple were in the convenient and gas station space. So we were looking at primarily these two things, and this was just a good opportunity. Pricing was well. In 2008, it also had a apartment built in to the right behind the front desk. So that's where we lived. We lived in the motel. It was 24/7 rooms, housekeeping, front desk, everything inclusive. So it was my parents running the show, and then me and my brother would come home from school. Our bus would actually drop us in the hotel parking lot, hop out of there and then go help them out for whatever chores were left to be done for the day. So that's how a lot of us got started, whether it was liquor stores, gas stations, or motels. That's how, most of the stories for Patel family start in U.S. because we are very business oriented.
I'm glad it wasn't a liquor store. I'm glad it wasn't a liquor store. I'm glad your friend chose motel, right?
Yep.
Well, how old were you?
I was in 7th grade. Yeah, 8th grade, 7th. Yeah. So I'm not sure the age, but pretty young. So my brother was even younger. So
yeah. And did you speak any English at the time?
I did, yeah. My mom and my brother spoke English, so that what's made it easier a lot.
I see.
More,
Okay.
It was a lot better since we knew English because we studied in schools in India that were more English, or they were English oriented schools. So
So you're raised in hotels, right? Living in a
yes.
hotel, probably changing the sheets in the rooms when you got old enough to do
Oh
all that and
yeah.
everything like that, working, checking people in and all that. Yeah, yeah.
Yep.
Did the family work its way up and graduate into larger branded hotels from there? What was that? What was that like
Yes.
as you grew up and your family's investment portfolio grew?
Yeah. So once we had that small motel for about, obviously we bought it in 2008, so it was not the best time to buy any sort of business in '08. So we had to go through the 2008 crash and then go wait for the recovery to happen, get our equity back, everything. And we sold that property back in 2014. We make a good money on that one. And then my parents bought a Super 8, and then they have smaller investments in a lot of bigger properties now.
Mm.
So yes, that's typical. Like, yeah, we start small and then you take the money and the cash flow from there. And what's really advantageous was, SBA loans back then. You could buy hotels for about 15% down, 20% down. So
Hmm.
that was really beneficial because SBA loans were quite accessible for hotel lending back then, especially
Hmm.
in the 2010 to 2019 phase. So that definitely helped a lot of the
Sure.
community to cash flow these properties very well as well because they were
Do you
putting 20%
recommend?
down.
Do you recommend? I mean, there's somebody listening right now
Mhm.
that's looking at this as like a house hack on steroids. Are
Yeah.
you familiar with the term, right? I lived in a house
Yep.
hack with a 3 bedroom, 2 bath, and I rented it out to two buddies of mine. Not for nothing. This is a house hack, right? Where you're
It
living in
is.
a,
Yes.
20, 30 unit hotel and you're, occupying one or two of the rooms or whatever. Do you recommend that investment vehicle to one of the best ever listeners right now? That's like, hey man, oh my goodness, lights out. I'm going to do a lot more than living here for free. I'm going to cover
Mhm.
my living expenses and probably make good money while I live on property. Is this a
Yeah.
strategy? Is living in your investment asset like this a recommended strategy now you can look back on it?
Yeah. I mean, I would say yes to that any day. If you are starting off in your career, if you're looking at, buying a cash flowing asset, there are challenges. Obviously, it's a 24/7 business, right? Compared
Mm-hmm.
to a store or convenience or gas station where you can actually get a little bit of sleep at night. You're going to
Yeah.
be in here for 24/7. So I would not recommend doing it by yourself. If you and your partner or your spouse were going to do it, then I'd definitely say yes, it's still worth it in today's market. If you can buy a hotel that's doing like $1 million at a good valuation, you yourself running it, you can probably make anywhere
Yeah.
from 200 to $300,000 on that one property. So it's still very lucrative at the end of the day. It is very hard work, like I said, right?
Bottom line, couple $100,000 bottom line cash flow after
Yeah,
expenses and everything like
yeah.
that.
If you're gonna work it yourself, yeah.
Yeah.
So
So
that
think
includes your
about that.
payroll and everything in there.
Think about that, best ever listeners, right? You're not just covering your living expenses. You could make like, low six figures by covering your
Mm,
living expenses. I know that's not what today's show is about,
no.
but stay tuned for Haith's book that's going to come out called The Burr Strategy on Steroids, right? I'm sorry, The House Hack Strategy on Steroids is another one. The House Hack on Steroids is not what we're talking about. But at some point, you decided to fall in love with hotels. You graduated high school. You decided to get into hotel. Why? Was that just a natural transition for you? Was there something you liked about the hotel world that you wanted to make that a career of yourself? Because I met you years after you got out of college.
Yeah.
So you had made a career working for, like family offices and hedge funds that owned, large portfolios of hotels. Why'd you choose that career?
Yeah, so I started off actually after college in underwriting in insurance, which I wanted to be in the actuarial route, but however, I just was not very good at office work of that sort. It was
Yeah.
fun, but I wasn't using my capacity to 100% of my brain capacity. What I do liked about hotel was deals, right? Deals from the start to the end, doing the full cycle deal, finding deals and doing renovations, doing fixing up operations.
Mm.
So that was more of a hands-on business approach, right? That's what I grew up with, the family around me and everything, and the friends. They've all been in that space where from a young age they've ran their own businesses. So that's where I was like, all right, hotel still makes sense. It's just the scalability and the numbers need to be a little bit bigger to make money on those deals if you're going to be syndicating them or having partners on them and doing the management yourself. So hotels, and actually hotels cash very well pre-COVID, right? That was the other thing, was they were very lucrative, especially for value add deals. not a lot, not a lot of people like to do the renovation, what we call a PIP, property improvement plan, which is something that the brand issues to you. You know, not a
We'll get
lot
into
of
that. We're going to break
yeah,
out the hotel glossary in a second here. You're going to be laying down
yes,
all the terms. So let's put PIP on the shelf. You guys,
yeah.
everybody write that word
So
down. PIP, PIP. We're going to
yeah,
unpack what PIP means and all the other fun things that Hait likes to drop on me all the time.
yeah.
So Hait, when you came to work at DeRosa at our company, and I'm
Mhm.
lucky enough to call you a team member here at DeRosa, where you do a lot of the underwriting and acquisitions and property finding and stuff like that at DeRosa, you've underwritten a ton of multifamily assets because when we
Yes.
brought you over to DeRosa, I had to make you stop talking about numbers of keys in hotel in apartment buildings. Like, oh, Matt, I found a 100-key apartment building. I was like, no, you did not. You found a 100-door apartment building, and we don't even talk doors anyway. Like, we're not a big door company anyway. We don't talk about that. It's just too, I guess too like transactional and everything like that. But
Yeah.
we had to make you start saying doors at DeRosa. So you've seen a lot of hotel deals in your past and now currently at DeRosa, and you've also seen hotel deals. What have you seen to be the difference between the two asset classes when people compare hotel? Like right now, there's a best ever listener right now that's all in multifamily and as I used to be, and God bless him. You're like, how do you compare the two asset classes as you've underwritten both?
Yeah, I mean, there's very similarities are always going to be there, right? So you got rent collections happening on a monthly basis in apartment complex versus hotels, we're still collecting rent, but it's on a daily basis. So that's the main differentiator. The other being brand standards versus having for hotels that we look at are in the limited service sector, and we're trying to buy flagged hotels that are, Marriott, Hilton, Wyndham, Choice hotels. So there's brand standards that come with each brand. Like Hampton Inn is going to have specific brand standards. Like you can only have this sort of paint color. You can only use this furniture package. Your carpets at all Hamptons are going to be similar. So that's the biggest differentiator, I think, is the brand standardization that you have in the hospitality, whereas this multifamily where you have the freedom to choose your own kind of package, right?
I'm going to lean into that for a second because I've learned a
Yeah.
lot from you about hotels. Like having a brand standard from a big, like $1 billion company, like Hilton, Marriott, or whatever, is like owning a multifamily and having it's like having Sam Zell or, Joe Fairless or some enormous apartment building owner come in and say, hey, man, what works for us? Paint your walls this color. Put these appliances in, put these flooring in, put these, paintings on the wall, have this color carpet, have all this stuff because we know this works for us. And so I want you to do, if you're willing to make all your apartments look just like this, here's what I'm going to do for you. I am going to forward 80% of the tenants that you need to keep your property full. I'll give you 80%. I'll keep you at 80% occupancy. All you got to do is through better management, you're going to manage up to get to the other 10 to 15% to be at 95% occupancy as an apartment building owner. That's our goal. That's where we want to be, 90 to 95, right? As if I was told by somebody, hey, I'm going to give you 80% of your revenue from the world, and all you got to do is just keep your property in the condition that I tell you to. Like that's like, as a multifamily guy, which I still am, that was my light bulb moment to say, oh shit, I get this. I see what we're doing now. I'm being held to a certain condition standard that I got to uphold. And if I do that, I'll get all the revenue I could ever imagine from this $1 billion company, right? How did I do?
That's correct.
Hey, layman's terms, explaining it.
Yeah, it's simply put, right? The brand is going to push revenue to your hotel, and that's going to be the cheapest form of revenue any hotel can get. Is that comes from the brand. And brand standardization is good in that. All right, if I'm going to go ahead and buy Hampton Inn, let's say tomorrow, the expectations from me are going to be the same expectation from even a bigger developer, right? They're going to have to do property improvement plan, which we refer to as PIP, on a same cycle as me. They are not going to get that benefit. Neither am I. All of us are included in the same basket. So, and it also helps from a customer loyalty retention perspective, right? If Matt, his avid Hampton in state, he goes out, he looks for Hamptons. Why? Because he likes the quality of the product he's going to. He likes the free breakfast. So the amenity packages and the stay there is going to be comfortable. So the loyalty membership speaks for itself. That's why, they will push 60 to 70% of revenue through
Man,
your
I'm a Hampton
loyalty.
junkie. I look for Hamptons, man. I'm like, I want the gym. I want that free
Yeah.
breakfast. My son wants the friggin' waffle machine. God bless. Let him do all that. I want the gym. My kids want the pool. I know what I'm going to get with the rooms.
Yeah.
I love Hampton. But going back to comparing multifamily,
Yeah.
let's look at the two things. What is an apartment building? Apartment building is a big box that people stay in, and they pay you over a period of time to stay in the box, and they expect their needs to be met. They want to be safe. They want, if they got a problem, they want it to be dealt with, and they expect a certain standard of customer service, from their landlord or from the provider of the housing. An apartment building, a hotel's the same thing, man. It's just they're not there by the month, they're there by the night. And they expect their experience to be this, that there's the expectations that they have on, God forbid they got a maintenance problem. They expect that to be dealt with. And they expect their experience to be very, standard. And obviously they want to be safe and everything like that. They want their experience to be predictable. Perhaps that's the word, right?
Yeah, predictability is the biggest thing, and also the wow factor, depending on what kind of market you're in. If you're in a tourism market versus if you're in just leisure transient market, right? So there's different aspects to it. And the other thing I wanted to mention is hotels are very operation heavy, right? Your payroll compared to multifamily is going to be probably 5-7 times more. At multifamily, smaller, like let's talk about 100-unit multifamily unit, right? We can do one manager and probably one maintenance person that can potentially take on that property and run with it. On a 100-unit hotel, you're talking about a staff of anywhere from 20 to 30 people. We're also responsible for creating a culture for that staff, which is also a component that I do really like, is that you're going to have anywhere from 20 to 30 people working at your property. There's going to be a culture you're going to be creating for that. There's going to be other components. And then the payroll is going to be substantially a lot more. You have this costs, you have shuttle drivers, you have housekeeping, you have maintenance persons that are probably full time, at least 2 of them on a 100-unit property. Some of them have to be pool certified, kitchen certified, all those kind of other things that go into it. So there's a big difference in the payroll and the personnel component.
The payroll component is, in my eyes, one of the reasons why I think a lot of people are a no on hotels, right? There's a lot of people, show me another asset class in real estate that has that many staff per doors, right? Or per revenue streams that you have to have that many employees. So that's why I was a no for a while on hotels. This may be my best ever listener right now. I was like, nah, man, there's no way I want to deal with that many people. So how do people that are major hotel owners, how do they mitigate that level of payroll? That's a thing, like to have to deal with that. You're always gonna have employees quitting and be hiring, you have to worry about when employees doing awful things that employees can do sometimes and stuff like that. How does a sizable hotel owner mitigate that level of staff?
Yeah, employee turnover. I don't know if you remember a couple of years ago, Panera posted that they had 120% turnover, and that was a celebrator factor, right? That means one person.
Panera, the sandwich company.
Yeah, Panera, the sandwich company.
And people were like, "Yay, Panera! You fired your entire staff 1.2 times and hired a bunch of new people."
So a similar thing in hotel is because it's hard work, housekeeping and everything. It's very tough work, and so for us, what we have found is incentives are really beneficial. Is like during the peak summer season, we always used to do bonus structures in the summers. So our, June, July, August being the 3 busiest months will be the months where we have a bonus structure where it's like if you show up on time, if you're there when everything is scheduled, you're automatically going to get $1,000 bonus per month. That really helps. Along with that, like I mentioned, the culture that you create at your property. If you're going to be a good operator, you have a good team culture where the employee communications are done. The retention ratio is a lot higher than what you expect. It's those operators that likely hire an institutional level property management company that are likely not going to get the results they want because they're going to have drastic turnover. And, the institutional level management company is not going to be as hands-on of an operator. They're going to be they're going to send either their third regional or the second regional, the property, they're not going to necessarily have the best team culture there. So those properties we have seen their P&Ls, right? They run notorious on the payroll because it's like they're training two people and they're probably going to fire three people the next week. So it's always a churning deal. However, from my perspective and the way I like to operate the property, I like to create a team culture. I like to really focus on incentives, end of the year bonuses on the middle of the year. And also just if I know that we have a full house tonight, give the GM a call this morning and just tell them, all right, just order whatever you need for food. Make sure everyone's fed. Make sure you get them enough, whatever else needs to be done to keep your employees happy at that point.
Yeah.
So the GMs have that freedom in that if they know there's a busy day, they don't even have to call me. They have the freedom to go ahead and spend, anywhere from $300, $400, $500, depending on the property and the needs of that property to make sure that the employees are taken care of. Give them an extra 15-minute break when get them food and make sure they're happy with that. So there's a lot of ways to reduce turnover.
So bottom line, what you're saying is that closer attention to management, closer attention to employee culture is the way you got to do it. And then at DeRosa, it's no different. I mean, we had an apartment building that had like 5 managers in 10 months because the PM company was just slowly taking their hands off the wheel. And we obviously we ended up letting them go and taking the property on ourselves to manage ourselves because we found that that's the best way to manage culture is to manage in-house. So it's probably no different in hospitality.
Yeah, 100% agree. And there's also a lot of regional players in hospitality, a lot more than I believe multifamily. These are the operators that manage anywhere from 10 to 15 hotels that are locally in that community. So those are the people that I like to work with because those regionals and those VPs and everything, you can call them at any given point and they will pick up your phone. They'll run to the property themselves in case if anything happens, like where there's not enough staff or anything. It's just not going to be the regional. It's also going to be the vice president, the president. They're also going to the properties and making sure it's being taken care of. You're not going to get that with the institutional level property management company of any sort, right? And these are also the smaller. And a lot of these property management companies are also owners themselves, which is also very beneficial because they're also looking at the P&L and not just they're taking care of the property, but they're also very heavily focused on the owner and investor side of things because they're also very heavy in looking at the P&Ls and scheduling and everything accordingly. So let's unpack the glossary and let's translate a little bit because I've never seen an asset class that's got such its own vocab as well as hotels. And I hear hotel people talking and I'm like, man, I don't know what y'all are talking about right now. You guys are using a lot of acronyms and a lot of words that I'm not sure about and everything. So we'll get back to PIP, right? Because we touched that a little bit. I want to hit PIP one more time, but let's talk about RevPAR. Because that sounds like a piece of a car, like piece of a vehicle. I gotta replace the RevPAR in my Chevy or something like that. What is RevPAR and why does it matter? And maybe what does it correlate to in multifamily? Yes, let's take it just a step back. So first is occupancy, right? If occupancy is similar in multi to hotel, except hotels are stabilized at 60 to 70% occupancy. Which is drastically different than running a multifamily where 90% is the bare minimum goal for occupancy standpoint. So rent is going to be translated to ADR, which is your average daily rate. That's the rate that as a hotelier that I charge on a daily basis.
Your average daily rate. Your average daily rate. Yeah.
Average daily rate across all rooms. So if the hotel has let's say 5 room types, suite rooms and, king bedrooms, 2 queens, all that, what is the average rate for each of them on a daily basis? That's what that means. And then RevPAR, what it is occupancy times your average daily rate. RevPAR stands for revenue available per room. So that is the actual. So when you look at physical occupancy versus economic occupancy, you can factor in all the money you're not collecting, all those kind of things. This is similar in that manner. RevPAR is the actual money that each room is bringing you. And that can be calculated on a weekly, monthly, yearly basis, right? Similarly to occupancy being calculated on a daily or weekly or monthly basis. So revenue per available room, and that's the important factor. That's what's telling me, okay, how much this market or this property, how much it's getting in this market.
does that like that correlates to if I've got multifamily? Multifamily always look like we got a 1-bedroom, and that's very different rent than a apartment complex that I might have that's got 2 bedrooms or even studios, whatever it may be.
Yeah.
Is a multifamily, you tend to break it down in dollars per unit type that you're making on a monthly basis. Then you got, RevPAR and ADR. Is that the translation, or is that how a multifamily owner should look at hotels? Because really what they're doing is you do the math, and those numbers should tell you what you're projected to make on a monthly basis in the asset.
Yes. Yeah, it's similar in that manner. What you just mentioned is truly accurate. It's like, it's what you're getting for after you take out all the concession, after you take out vacancy, after you take out bad debt, XYZ, this is what you're actually getting. That's RevPAR.
Here's what I like about RevPAR in hotels, in that it bakes in vacancy. You're considering your room usage rate. And so there in a multifamily asset, there is a way to somewhat conceal the asset health and talking about things like, well, I'm 90% occupied. Only 40% of my tenants are paying the rent.
Yeah.
So, I really like economic occupancy versus physical occupancy. Yeah. That's one game that people love to play. They also love to tell you, okay, I got this apartment complex and I just rented out a 1-bedroom for $1,500 a month. How about me? High five me. But they're not telling you that all the other 1-bedrooms in the apartment complex are all leased to $900 a month, right? So it doesn't matter what you got, that you pushed the statistical average up a little bit higher on one apartment. What are you averaging out in your net 1-bedrooms? And a lot of multifamily owners like to play that little shell game in telling you what their highest rent is that they're getting. Hotels tend to normalize these things because they're renting out daily versus monthly, correct?
Yes, exactly. Right. Like, and we have what is called a STAR report, STR. Smith Travel Report is what it originally was. Now it's owned by CoStar itself. So the STAR report,
these guys own everything.
So the STAR report basically, I know they got apartments.com.
I think
they even have homes.
They got Jeff Goldblum. Right? They got all of them.
Yeah, they got some as well, I believe. STAR report is where we submit so if you're part of Hilton, Marriott, IAG, or anything, you automatically are going to be enrolled in the STAR report, where you are going to be sending your properties report to the franchise, and they'll send it over to STAR. The STAR basically has a comps. The comps are going to be something you select, where you'll have 5-6 different properties, and your property, you'll have all of the data on what the average daily rate among those comps are. You'll have the data on occupancy, and you'll have data on RevPAR. And it's broken out every week. You get the report, so you can look at the 7 days of what happened and which days your property might be number 1 versus number 2, number 3, XYZ, which is very important for an operator, because for us, on looking at a value add, right, we can truly see the impact that we might have after doing, like, let's say a 200-room property, we do a $3 million renovation. We can see the upside from that report. It might be anywhere from $20 to $25 up. You're going to make really good returns on those kind of assets. Where it's underperforming right now, where you come in, you fix up the operation, and you're going to increase the RevPAR, and you'll get a really good equity play on that kind of property. So STAR report is the industry standard. Whenever we look at a sale, we at least look at 3 years of STAR report
to figure out that RevPAR and see how it compares to the market.
We take the average of 3 years in hotel industry. And the multifamily side, how we look at trailing 12 as the more important aspect. We will ask for more data. In the hotel industry, the norm is 3 years of data, because it's actually, the revenue fluctuates a lot, right?
It's much easier in multifamily. I'm going to just come at you how multifamily is easier, man. Multifamily is easier to pull comps, not for nothing. If I'm buying a 100-unit apartment building, and I know that right down the road that there is a similar vintage, 50-unit or whatever, I know that's comparable enough. So I'm going to look at their 1-bedrooms and see what unit condition are compared to my 1-bedroom and see, okay, that's about the same, right?
Yep.
It's easier to comp multifamily. Not so. If I'm buying in hotels, man, if I'm buying a home 2 suites and there's an Embassy Suites right across the street, that is not a comp. Even though it could be built in the same year, it could be right on the same block right next door.
Yeah.
But Embassy Suites or JW Marriott's or whatever it is you want to compare it to, are not the same as like a Home 2 or a Hampton or whatever. So to your point, that stall report is really a aid in normalizing the field a bit, so you can look at the same asset class. You can compare asset classes. So I submit to you, the multifamily is easier to comp.
It is, and actually that brings up a very good point on the asset classes within hospitality sector, right? Because what you mentioned, Embassy Suite, Home 2, JW Marriott, those are three different asset classes. There's a lot more. So in hotels, we have luxury, which would be like your, class A plus apartment style. So that's your Ritz-Carlton, the JW Marriott, the Conrads, right? And then those are all full service resort style hotels. And you also have a little bit below that mid-scale luxury. And then the asset class we really focus on is mid-scale or upper mid-scale limited service. So limited service is, it might have a restaurant from time to time, like a Courtyard. If you have stayed at a Hilton Garden Inn or a Courtyard, they have like a little restaurant with a bar that's, doesn't have a full menu bar like food options, but it's enough to basically, if you had to eat there, you had enough food to get you going.
You said if you had to eat there, I'm like, man, I can't go anywhere else. I guess I could go to the Hardee's across the street, or I could eat. How many microwaves do they have in the back? Right? What's that?
It's more focused on the drinks at those kind of places. Like there's food options, but it's more heavily for people that are
we've all eaten there. It's like, that's what we got to do. And it's just a limited service. Look, they have a place for food. It's not like a 5-star, not Michelin, certainly not a Michelin star restaurant or whatever. It's just a place to eat with reasonable things that you can have in a bar. Off you go. Right. Keep going.
Yeah. So limited service is the space that I focused on all my life. I mean, this is going to be your Hampton Inns, your Home 2, Sparefields, Holiday Inn Express or Holiday Inn, Courtyard. And those are all just the big name brands that most people are quite familiar with. In this space, the payroll and the number of employees needed to run a property is going to be a lot less compared to a full-on luxury hotel.
What are some things you see in a luxury hotel? Like compare that to like, well, what is your favorite luxury hotel to stay in, Hait? Because I bet you splurge every here and again. What's the one that you like that you look up to and think that they run a really good show? Do a little name drop promo for that luxury hotel that you think is a good delineation between limited service to a full service hotel. Talk me through it.
Yeah, I mean, if you have stayed at a Ritz-Carlton,
there we go.
The moment you walk through the door, it's a Ritz-Carlton.
They got a fountain.
From the decor to the bed sheets to the towels, everything is going to be a lot
marble
more
right
expensive.
There in the foyer, a fountain going on, the whole thing.
If they'll have a little boutique, they might even have a salon, a spa, two or three restaurants.
Sure do,
depending on the location. So that's the ultimate difference, right? Is that they have full service. They have massage parlors, they have spas, you can get haircuts. Everything is included in that one building.
Yeah,
limited service space. We step back and we're like, all right. What do people need? They need a gym. They want a free breakfast, and they just want to be in and out quick. And if there's, if you said a Hilton Garden Inn, for example, there is that restaurant component. So if you wanted to come back and have a drink or two at that hotel bar and then just go get your sleep after that, you have that option.
Here's what I've learned. Okay, this is my view, because I love me a Ritz-Carlton too. Hey, as you can tell, I love it. But a lot of the things that you experience at a Ritz-Carlton are there in a just diluted or lesser sense, in a Hampton or in a Home 2 or whatever. They might not have a bar with every bourbon you've ever heard of in your entire life, but they likely have maybe a bar, a full bar, but they might just have, like, I stayed at a Home 2 with my family a couple weeks ago, and they had like a cooler. You walk up, and they got beer, and they had like
beer and wine.
Jack and Coke in a can. Didn't know they did that, but here it is. But they've got, if you want to have a cocktail, there it is. There is a gym. It's maybe not as nice as the gym at the Ritz-Carlton. Okay, they do have some food options. They have a free breakfast at the Ritz-Carlton or whatever. Certainly it ain't a free breakfast. It's going to cost you $45 a head to have breakfast. But it's the experience there is a diluted version of the same experience. Would you agree with that?
It is, exactly. It's a hotel at the end of the day. The amenities are the only thing that are different again. But the demographic mix is where it's interesting for us, because in the limited service space, your demographic and the demographic you can go after is a lot larger of a population, right? You're talking $100 to $200 nights on peak seasons. whereas a Ritz is going to be anywhere from, I don't even know,
Nah,
like 1,000 to 3, 4,000 or
could be.
5,000. Yeah.
Yeah,
So that
could be.
traveler and the consumer mix is very different, right? From a demographic
That's
perspective.
what I like
I
about the
don't,
limited service hotels. Now, like I said, you're getting a diluted experience, but you're
yep.
also paying, what the average American can afford to pay. And just like, what's it, it's a little more comfortable to pay, 100 bucks, $150, $200.
Yeah.
That's like, you tell me I drop $150 and I get free breakfast for my family and I get, a gym and a pool and all that. Yeah, I get it's not, all the things that the Ritz-Carlton has, but it's enough. Right. So
Yes.
that is your pitch to me years ago, which is this is why limited service is a good investment class, because it serves the full spectrum of people. It serves the business traveler, right? It serves the traveling family, which I was a couple of weeks ago when I was out in Martinsburg and I stayed at a home too. And my family had a ball. My kids didn't want to leave, So that's what I've come to enjoy on limited service. By the way, side note, do investors, syndicators, people, not companies, things like a Ritz-Carlton or a Ritz-Carlton owned by the brand? They really?
No, a lot of them are owned by institutional, and then there's also privately owned and other things among syndicators and bigger developers and all that. So no, they're not fully owned by the brand. The brands have actually liquidated most of their properties that they used to own. They used to own a lot more resorts.
Man, I hate to see what
like 10 years, they liquidated a lot of their
How much is a PIP? How much is a PIP for a Ritz-Carlton? Again, that's a property improvement plan. You got to come in on it once every 7 years ish, and pretty much upgrade everything so it feels nice and fresh. You don't know what the Ritz-Carlton.
It's just so hard to guess. Like if it was in Americas, it can be anywhere from like 60,000 to 200,000, depending on which market it's in.
A unit.
And for that, and that's the price you can build for, right?
That's per key, best ever listeners. That's per unit, 60 grand. Right.
Well, you have to replace the marble showers. You have to replace all the furniture, carpets, and that's a lot more expensive carpet than you have in the limited service sector.
All that brand name furniture and all that kind of stuff, and like real hand painted artwork in the hallway.
What is it? They some of the Ritz-Carlton now carry Dyson. What's that? The Dyson hair product. The air.
You mean the hair dryer?
The hair dryer, yeah, the Dyson hair dryer. So
that's $100 hair dryer. Yeah.
So each room was going to have a $700 hair dryer, along with probably an espresso or a Keurig machine in there as well. So there's another $1,000 or so there. So like I said, the amenity package is a lot better.
I want to unpack a part of the PIP thing that again, yet another thing for me as an owner when I was like, man, no freaking way am I getting involved in hotels, that I got Hilton or Marriott or whoever else, $1 billion company that's got way more money than I do, breathing down my neck, telling me how much per door I'm going to have to invest in this property on a 7-year basis, that I get Big Brother coming in being like, all right, that's it. I know this bed looks just fine, but you have to throw it away and go bring in another bed and new sheets and new paint and new, bar furniture and new all of it. And oh, by the way, we decided we're changing colors now. And the Hampton Inn brand isn't going to look the way it looks anymore. We're going to change the whole look for Hampton Inn. And so now we're going to, you got to repaint the whole exterior of your building. Sorry about that. Right. That plan really talked me out for years out of even thinking about hotels. How do you mitigate that?
Yeah. So like in our experience, right, PIPs are actually good because it allows for the whole brand to withhold standards. If you're going to have a couple Hamptons that are just garbage and that's going to draw down or draw people away from the brand, that's not going to be good, right? So, with a typical Hampton, for example, when you build a brand new Hampton, you have about a shelf life of 45 to 50 years on that. After that, they will kick you out of the system unless the location is kind of irreplaceable, because the building in itself is now, not worth a flag of a Hampton. Like you'll see a lot of the properties that used to be Hamptons 2 stories back in the 80s, they're no longer going to be Hamptons. They're either going to be an economy segment hotel of some sort where it's just been, run down and it'll just continue staying. Yeah.
But a 45 to 50 year cycle is pretty good to maintain your flag.
It is. If you're an investor, right, you're going to, get your money out in the first 5 to 7 years regardless. So after that, it's just cash flowing for another 40 years, and you probably going to have it paid off in, let's call it 25 years maximum.
How do owners deal with that? Like, how do you, as an owner, if somebody, the best ever listener right now is like, yeah, you know what, I'm going to look in, because best ever listener right now, go on LoopNet and there's hotels out there for sale. So somebody's like, okay, I want to go buy myself a Holiday Inn or a Hampton Inn or whatever, or, or whatever. You go buy a freaking Ritz-Carlton, whatever. How do they deal with preparing for, Big Brother Hilton, Big Brother Marriott, showing up and saying, okay, I get limited service is going to be 10, 15, 20 grand a unit. And big property improvement plan once every 7 years, 10 years, whatever that may be. That could be a business crashing bomb they drop on you. How do people prepare for that?
This is the reason we are buying bigger boxes, that being in anywhere of the revenues like 3 million minimum to could be 4 or 5 million, right? Because every year we set aside at least 4% of our revenue towards a reserve that's for the furniture or for a PIP reserve. And that money over 7 to 10 years, that's going to amount to anywhere from 1.2 to 1.7 million, depending on the revenue for us.
You're supposed to do that multifamily. Nobody does that multifamily. You're supposed to. You see, every underwriting in multifamily shows a CapEx reserve. Like, hey, set aside some money because you never know when you got to replace your HVAC, so you got to replace your this, replace your that. But you never hear of an owner setting aside a lot of money to do big capital improvement reinvestments. Like, I'm going to reskin my buildings. I'm going to repaint all my common areas. I'm going to do major stuff to make the experience feel fresh for my residents. You don't hear about that. It's probably because multifamily just doesn't pencil out to set aside that kind of cash flow. But a hotel does for one reason or another, probably because it has to. It's mandated by Hilton and Marriott. You want to keep your flag, you have to do these things. So
the mandate is one thing. The other thing is where you're going to be focused on is a customer, satisfaction, right? If you are paying $100, $150 and going and staying at a home to a Hampton with your family, you're trying to go out for the day or night, and you want to enjoy that stay as well. So the carpets have to be replaced every 10 years minimum, and even the paint, because there's usage. If you're running with 70, 80% occupancy, there's going to be wear and tear within the first 7 to 10 years. So you're going to have to start replacing those items regardless, just because of the wear and tear compared to a multifamily, where you might have a more stable tenant that's in the apartment for 10 years, but there's not going to be completely worn down. So, and even then, like a turnover rate, typical turnover you're seeing in the industries anywhere from one year to maybe 2 years. And we still have to go in and spend, anywhere from some of the units where you have to spend like maybe $1,500 every year. You might count, or it might be a different cycle, but the numbers kind of even out in that you're spending $10,000 to $15,000 at one time, versus in multifamily you're spending over a period of time. A
multifamily can be a death of 1,000 cuts, in that, like, I could have a resident move into an apartment, do, lots of wear and tear. I've got to go, as you said, invest $1,500 should be in kind, probably more than that, in a unit upgrade and bringing it back online. And then that happens every year or two in unit upgrades and in turns. You could end up spending 10, 15 grand in turning those units over and over and over again. And God forbid you have a HVAC die in the middle of that process too. You do end up doing the CapEx, but it's probably less planned than it is in a hotel, where it's like, you're like, I'm going to, not gut this whole place, but I'm going to reface this entire asset every 7 years. And I'm going to set aside money to do it over the next 7 years so that I have those dollars there. So it's really just part of the business plans. It took me a while to get it, but I finally got it, I think.
Yes. And the other thing is, from a operations perspective, you do have another budget of, anywhere from $70,000 to $140,000 for repairs and maintenance on an ongoing daily basis. That includes your supplies and everything, your pool supply, elevator contracts, just any sort of small breaks that will happen, replacing refrigerators, tech units, all those. You do have a budget for those as well on a daily basis.
Does Hilton help with that kind of stuff? If I'm a brand new operator and I want to, I'm the best ever listener right now, and I want to get in, I want to buy my very first Hilton asset or Marriott, whatever. Is there Hilton owner school that I can go to? McDonald's has Hamburger University, right? Can I go and learn how to become an owner of a hotel if I want to enjoy the benefits of hotel ownership? Do Hilton and Marriott teach people how to do this?
So if you want to become a property manager, in Hilton or Marriott or IHG or some of the bigger brands, you do have to be approved by the brand to be a manager of their property, which does involve you going and doing trainings.
Yeah.
However, there's no training that's going to teach you all of the basics to running a bigger property that's doing 3-4 million of revenue, right? But the properties that are within the choice window families, like your Super 8s, Americans, and La Quinta, or not, sorry, La Quintas are a lot bigger down in East Coast and down south, but up here in northern or Minnesota, we do have some smaller La Quintas and comfort suites. Like those kind of properties, you could take a more hands-on approach as an owner operator, and they do have courses and everything where they will teach you revenue management, sales management, and you can take those courses along with that.
That's good to know.
Doing the actual work of running the front desk yourself, housekeeping,
Man,
to learning the actual business.
Show me another asset that'll do that. Okay, here's the biggest that I had in looking at hotels, and this is going back to best ever listers, the big box, right? Big box, apartment building, big box. It's a box that spits out money on a monthly basis from folks that want to stay in that community, whatever. A hotel is a big box too. Same thing. A lot of correlations. Big difference that I saw, right? And there's reasons for this, but it really blew my mind that apartment buildings, and this is let's all own this, best ever listeners. They make money, but they make a lot of their money when you sell them, right? They make very little money, if anything at all. True story, while you own them, right? They might make a little bit of cash flow, a little bit, maybe you can tweak it up to 7, 8, 9% cash on cash, or maybe even magic fairy dust gets sprinkled upon the deal and it refinances and you're making 15, 20, we've all seen that OM, right? 15, 20, 30, % cash on cash comes out, once the magic fairy dust goes on the deal. And then but that's typical multifamily. Real numbers are, low to mid single digits cash on cash. Yep. And then the property sells, and straight up, man, you could make 20% for your investors. Fact, when the property sells, it could happen. And the reason for that is because the cap rate is so low that all I have to do in a multifamily asset is squeeze another 10, 20 bucks a door in revenue or in expense savings out of the property. And at a low cap rate, that translates really easily to a bottom line NOI. And that NOI translates to a high profit. Not so on hotels, right? Because, hey, for one reason or another, and I still don't get this, I think this is going to change. But if for some reason or another, hotels trade at a much higher cap rate than apartment buildings.
It is, right? It's the risk-adjusted return. Multifamily is seen as a safer asset. Not of a daily headache compared to a hotel where you're, trying to monitor breakfast costs, payroll costs, everything in between, right? But yeah, hotels typically trade at 8 to 9 cap valuation. And, our interest rates, at least on the regional banks right now, we're at 6.5 to 6.75. So we have a delta of 150 to 250 basis points going into a deal. The delta, what I'm referring to is your interest rate, your borrowing is at 6.5%. And let's say you got the deal at 8.5 cap rate. You have a 200 basis point spread there, which allows you to cash flow these properties. What's happened in multifamily is that we're still seeing a lot of deals that are being offered. We're going all in at let's call it lower 5.25 cap rate. However, our interest rate from agency debt we're seeing is, in that same number, it's going to be around that 5 to 5.5 range. So we're not able to cash flow those properties because there's not really a spread. If we do cash flow them, we're doing it on an IO basis. If we have interest only on the loan, then we'll see a bit more of cash flow.
Yeah, bottom line, man, you got to play games to make a multifamily under today's numbers. It's sold at a market rate cap rate of 5.5%, 6% cap rate. If you're going to borrow money at today's interest rates, you need to play some games to make that property cash flow. That could be IO, as you said, or a cash flow reserve or whatever it may be, to say it nicely, but not so for hotels. I was like, wait, why are these things trading at such high cap rates? And it's because of a perceived risk factor, not a true risk factor, but a perceived risk factor that hotels are at. And again, I think the secret will get out eventually. I know you might disagree with me, Hait, but I think that the secret will get out eventually on how cool hotels are. And I think the cap rates will start to compress in the hotel world as more and more people do hotel deals. So I think that currently hotels are at 8, 9% cap rate. Are they going to go to 4? I hope not. Because that's just stupid town where multifamily went. But is it possible for a hotel to eventually, for the hotel world to go to 6.5%, 7%? Possibly, as more people start to see it as a good space. But for now, if you're buying an asset for a 9% cap rate and you're borrowing money, as you said, 6.75%, you're doing this wacky thing that it's hard to see an asset do these days. And it's called cash flowing the first day you buy it. If you run it right. And again, as a multifamily operator, I'm like, okay, so I can buy a multifamily asset, run it well, make a nice, reasonable stream of income, maybe a creek of income, maybe not even a stream, a little creek of income coming into the property. And then we make a huge torrent when the property sells. Whereas a hotel makes a really nice stream of income, a river of income coming in, but it ain't free. Here's the other side of it. Because hotels are trading at the high cap rates, they don't sell for much more than what you paid for them. So it's very true. You could buy a hotel for 10 million today and sell it for, 11 million in 5 years. Whereas in a multifamily, if you're paying 10 million for the multifamily today, your business plan better say you're going to sell it for like 19 5 years from now, or you won't make any money for your investors because you didn't make any cash flow at all during the hold cycle. So you better make it all back on the back end. And you probably will,
Yeah, no, that's a really good comparison. Cash flow, cash flow
versus appreciation.
Exactly. And hotels, the going in cap rate and everything matters, but there's also different ways we look at it. It's not just there's also a revenue multiplier, which is, your revenue times a certain multiplier that's going on in the market. Like right now, most markets are trading at 3.5 to 4 times multiple. So if your hotel is doing 4 million in revenue, a 4x multiple, just 4 times that. So the valuation is going to be around 12 million for a buyer. But then you also have to take into account the PIP cost. And, so it's not just going to be cap rates that are important in hospitality. We also are going to look at replacement cost too. If I'm going and buying a property let's call it, we looked at a property like this. It was a 2008 built property. It was performing very, very well, but they wanted to sell at 200,000 a door. And at that point, it makes sense because I can build for the same cost of going into, that market. In which at that point, I'd rather just build a brand new 2025 built property.
That was the one in Green Bay, wasn't it?
PIP. Yeah.
That's the one in Green Bay. Oh man, yep. I was so mad because I used to love the Green Bay Packers growing up. I'm like, I don't know why, but I've never been to Green Bay, but it's so cool to go to Green Bay just for that. But well. Hey, that's a good factor on replacement cost versus what you're paying, because it's not easy to build a hotel, but that is a big factor. That somebody could just build a brand new hotel that's a block down the street from my hotel, and they could charge the same have the same ADR that I'm charging now, and they could really, really put a squeeze on my business. So it's a factor.
Yeah, it is a factor, and that's the risk associated with why the cap rates are higher, right? In a recession, hotel revenues do tend to drop. However, that's why we're focused on the limited service, because even in COVID, limited service was the least out of all the segments. It was the one that took on the least impact. In some markets, they were even profitable. And even in the 2008 recession, it was a similar thing in that, these limited service hotels took on the least hit out of all those segments in hotel. And then what matters really is the flag that's on a property. If you own a Hampton or a Home 2 or a Residence Inn, you're not really worried about new property opening next door because you are the market leader in most of those most of the time you are the market leader because you have those flags. Unfortunately, if you owned a La Quinta or a Comfort Inn and a new property opened up next to you, then you will see a big impact on your revenue. So it is very crucial to look at, new constructions. However, right now, new construction is just halted because the cost to build does not justify the revenues that the hotel produce.
Because you could buy something built 5 years ago for, 30% less, just because of spikes in construction costs. It's a true story. Okay. Bringing it home, Hait. Tell us real quick some things that you're underwriting a deal, right? I love this question. I've asked this question for you on many webinars and whatnot that we've done at DeRosa for multifamily, but I'm going to ask you this for the first time on a hotel. Deal hits your desk. Give me a thing or two that you see and you're like, I'm out. Nope, don't like it. Throw it away. And then after that, give me a few, two that you see and you're like, ooh, this could be a good deal. Obviously, you're not going to say yes on 2 things, but give me 2 things that are really, really promising and 2 things that you're absolute no buttons. If you see them, you're going to kill the deal.
Yeah, so I'm going to mention three things.
Go
One is
for it.
going to be property tax. Second is insurance. And third is the age of the building.
Hmm.
Like you mentioned, there's a shelf life to these properties, right? So I'm not trying to look at any assets that are 2008 or older at this point, because of the PIP cycles and how they are. The other insurance, as we know in multifamily, insurance hotels is even just a little bit more crazier in southern markets or specifically in areas with higher crime rates. Right now, a lot of the umbrellas and liability insurance are just dropping out. The carriers do not even want to be in that market. Similar to flood insurance in these markets, it's just going to be impossible. And if you do get a carrier on a new policy, your policy is going to be increasing anywhere from 25 to 50%. So that's very important for me to look at the insurance that currently the property is at and where we'll end up at. And lastly, property tax, right? In Minnesota, for example, property taxes on hospitality are very high. So we have to be very cognizant of what that, reassessment is going to look like if we have any
Hmm.
tax savings. Similarly, like compared to North Carolina, where property tax and hospitality are a lot more competitive in that market, so they'll cash flow a lot better. However, we're getting higher rates here, so it kind of makes up for it. So those are the very three important things. If I see a market with very high property tax where there's not a lot of appeal and insurance is just crazy, that's a no go. And then lastly, just the age of the building. At this point, we're looking at properties that have hopefully two elevators, 4 stories, interior corridor, and a good flag on them.
All right, so hey, let's take it from the other direction. Let's say a hotel deal comes across your plate and you're like, ooh, heck yes. These are some equations of a really good deal. Let me keep digging in. What are some things that you see that you really like when a deal first hits your desk?
Yeah, so if I look at a property and let's say that's a very attractive cap rate, if you're talking in the high like 10, 11%, that's obviously going to be very attractive.
And it's not like a super
That's
8.
always,
It's not like a super 8 or something like that,
I mean, if it is a Super 8, it's a good location, it might be a yes, right? So,
Oh yeah, all right.
like I said, if the cap rate is there and it's attractive and it's going to cash flow day one, because if you're talking 11 cap, that's cash flow is going to be like 11, 12% day one going
Mhm.
into the deal. At that point, your investors have their money back in like 5, 6 years, and the deal's going to cash flow continuously. The other thing, what I really like on our value add side of things is if I see a property that's in a good RevPAR market, let's say $90 RevPAR, and the operation side of things, the NOI is low, that means there's a lot of good upside and opportunity, particularly if it's all currently being managed by an institutional level management company. Then I definitely know
Mhm.
there's a lot of upside. Um, there's big companies out there that are just known in the industry as they're not the best operators. It's just, if an asset is institutionally owned by Starwood or anything, then they usually pick one of the bigger players because they manage their entire portfolio across the country.
Hmm.
So those kind of properties is where it really excites me because then I know the potential upside is a lot more than just the value add component of it. So
Hmm.
if you did the PIP there and you fixed up the operations, those properties can be really good on the equity side of things, and you'll see a lot of appreciation on that.
It's so interesting. Like you're speaking with all the, you're speaking in tongues over there with all the terms of the pips and this and that.
Yeah,
But you're talking multifamily value,
it is
and
family. It is
you're over
value
here
add.
like, okay, this property's not improved well, and it's not performing at market revenue or what I know the market can do, and
So,
it's got a crappy property management company too.
so the
Right?
difference
Yeah.
is, like I mentioned, is that if the revenue's there, but the bottom line, that's where it's
Yeah.
best because now I'm not chasing revenue. I'm not trying to increase it. It's like I know the revenue is performing. How do I fix the bottom line? And if I do the PIP,
Ah.
I'll see another 10, 15%
Okay.
improvement in revenue.
No, you're
So
right. Because
those
a lot of
are,
multifamily tends to, in the last 10 years has been
yeah,
about pushing the top line. Have
yeah,
I say, okay, this property's running at, 65% expense to income ratio. And the reason
yeah,
for that is the rents aren't high enough. And so I'm going to push rents. I can't really do anything about expenses because it is what it is. I only got 2
mhm,
employees. I can't do this, can't do that. I think that's really not true in multifamily. You actually can do better expense management in multifamily, but a lot of people in the last 10 years have been just pushing revenue. So you're saying it's
yeah,
the other way around for hotels. It's saying like revenue, if it's performing at market, but it's still not making money, that means that something's not right inside the box and I can make it run more efficiently through better management.
yes, that
I
is
love
true.
it.
especially with the better operator, those properties will cash flow immediately. And, like you mentioned, the ratios are important. Like if the property, like a Hampton, should be doing a 33% margin, and if it's doing like on paper, it's doing, I just saw one the other day that was doing 13% margin. So, I know there's an upside of almost 20% there. So that's those are the properties that are heavily focused on trying to find those assets where it's like you're getting a good cap rate going into the deal. And then by the time you exit, you bring up the revenue. You're not only going to get the cash, you're also going to get the equity bump from those two.
Love it. Okay. Let's bring it home because this has been a great conversation. And you've opened up my eyes in a lot of ways at DeRosa, at our company, in the way that multifamily versus hotels can operate and can be a good complement as a comparison. So thank you for teaching me and for our team on the correlations between the two, and for teaching best ever listeners too. So best ever listeners, if this conversation is inspiring you about, just learning about how to underwrite hotels and how to evaluate. And if you're thinking, 9% cap rate sounds interesting, 8, 9, 10, 11, 12% cash on cash day one of ownership sounds really good for myself or for my investors. Yeah, I want to make an offer to you guys. Hait and I and one of our other teammates, Jacob, are going to be doing a deep dive and discussion on hotels versus multifamily on a webinar here on the Best Ever Network on July 24th. So if you guys would like to register for that webinar, go to bestevercre.com/hotels, bestevercre.com/hotels. And we will break it down further. We'll get into all kinds of cool stuff about like, what does even value add look like in a hotel deal? What does buying a stabilized asset look like? We'll show you guys the financials, the underwritings, and we'll go next level. So you guys can learn to do this thing yourself. And if you guys are interested, we'll also present an offering to you guys that DeRosa Group has that are 2 hotel deals that we're in the middle of right now. So if you're interested in hearing more about that as well, we'll be talking about it in the webinar too. So one more time, bestevercre.com/hotels. Hope to see you guys there. Hey, thank you. And I will see you there too, where you'll be laying the smack down and teaching us more hotel investing conversations on that webinar as well. But thank you for joining me as a host on the Best Ever CRE show today. Best Ever listeners, thank you guys for listening. Hope we gave you guys something to think about next time you guys stay in a branded hotel. Think somebody owns this thing and they maybe syndicated it. Maybe that could be you. Next time you stay in a hotel, you could stay in a hotel that you own as well with a group of investors. Until then, Best Ever listeners, have a best ever day.